Welcome back, listeners. My name is Larry Kallevig, founder and CEO of the Haven Financial Group. And if you're just tuning in, you are listening to the Haven Financial Group radio show, where we discuss crucial retirement and financial topics that can really make the difference between surviving retirement and thriving through it. If anything resonates with you today on the show, feel free to give us a call at 612-504-8400. Visit us online at havenfinancialgroup.com. Kim, we've started up the classes full force this year. We just had 2 of them this past week. They were at full capacity. People are eager to learn. And what's better than to start it out with education? Education can be the potential to make good decisions rather than bad decisions. And that's really what the goal is, especially if you're getting close to retirement or in retirement in any of these retirement areas. Don't make it complicated. Our job is to simplify things.
Absolutely. Yeah. Fumbling the ball is certainly not what you want to do when you get down there in the red zone. Pillars of retirement planning in 2026. That's what we're talking about. Lance Larsen is with us, CPA there at Haven Financial Group. We've just talked a little bit about gifting some of your wealth, so that there are, because there could be so many tax ramifications. We want to talk a little bit more about inherited IRAs and the 10-year rule associated with that. I guess, Lance, I you never think about people inheriting IRAs, because I think, gosh, when you get to retirement, you start to spend that money. And so maybe that doesn't exist anymore. But certainly people do inherit IRAs.
They sure do, Kim. And especially with the next upcoming generation, that the 401ks has been the primary source of retirement. We look back 20 years, most everybody was having a pension. So therefore IRAs, 401ks, they didn't really exist. But since like the mid 80s, now it's become more the retirement vehicle of choice for most businesses. Pensions kind of gone away. So at that point, now you can start seeing people that are putting lots of money into that 401k, which then they roll into an IRA. But then they don't spend everything because they're always worried about not spending their money before they die. So now you're stuck with a person who has a decent sizable IRA and it's going to their beneficiaries. What is going to happen? Well, a little bit before the Secure Act, there was a guy by the name of Ed Slotz who cut about a stretch IRA where the beneficiaries would just keep taking their little RMDs, taking a little sliver out and taking the little amount that they had to, but which is always going to be less than the rate of return on the IRA. So therefore they're going to have a net growth on that. And that IRA would just go into a big, big dollar amount. Well, thanks to the Secure Act and the Secure Act 2.0, the Congress has kind of closed that down and says, nope, you can't do that anymore. So they have put a 10-year window for most beneficiaries that they have to clean out those accounts. So if your parent passes away and then you inherit that IRA, you have 10 years to get all that money out of the account, pay the taxes on it, and then the IRS doesn't really care what you do with it afterwards. But that's where we talk with financial advisors like Larry and say, hey, what do we do with this money?
Sure. Okay. So that has gone into effect. What else do people need to know? First off, if you have IRAs and setting that up in your estate for those who receive it, and then those who receive it, what else do you need to know?
So a lot of it, because the IRAs are going to be taxable income, we do need to plan for that income.
Okay.
So some people say, hey, just let it sit in there for 9 years, 11 months, and then I'm going to pull everything out at the last moment. Okay, well, that's definitely an idea. Is it the best one? Most of the time, I would say probably not, because at that point, you're going to have to take out a huge, large amount, and that is probably going to jump you up to maybe even 3 tax brackets. And you're going to give a bunch of money to Uncle Sam. Versus if we plan it out that you take a little bit here, a little bit there, especially if you inherit this one when you're getting pretty close to retirement. So let's say that you're at age 65 and you could either retire today, next year, anytime that you want. Well, while you're still working, maybe we just take out a small amount so that we don't pay a lot of taxes. then you decide to retire. Now, instead of touching your accounts, we actually will take in the inherited IRA and we'll use that money to fund your lifestyle, and we can get that cleaned out in a year or two. Um, so that's why there's a lot of planning that needs to go into this. Otherwise, we're going to end up giving more to Uncle Sam.
You bet. What happens if you miss that deadline of 10 years?
Then there's going to be penalties.
Okay.
So we avoid the penalties at all costs there, and we just don't want to go down that path of trying to reduce those penalties. Because typically when you have RMDs, you miss them, there's a 25% penalty, which you can then try to get that reduced. With this one, if you miss the 10-year line, there's no reducing that one.
Kim, if I could add, and I'll just go back to some fundamentals. You're listening and you go, RMDs. What's RMDs? Required minimum distributions, where the government says, hey, you haven't drawn on that IRA yet. We're getting impatient and we want some of that taxpayer dollar. You're forced to take it out, which a lot of listeners will probably remember 70 and a half. It was that way for years. Then it went to 72. It's currently 73. And I think it's 6 or 7 years it goes to age 75. We want to plan accordingly for that, because as last mentioned, that's additional income that's going to come into the household. So if there's anything we can do from a tax planning strategy in those earlier years of retirement, Roth conversions, whatever it might be, we definitely want to take advantage of that. We have some clients, and again, others do as well, where, hey, Larry, we don't need our RMDs. We are charitable. We like to give it to the church or some sort of nonprofit. Can we do that? Yes, the qualified charitable distribution can be set up. There can be tax benefits on both sides. Please don't wait till December 31st, which a lot of people do, but we want to avoid that. We want to plan accordingly. This is all part of our normal planning process. I don't care how old you are or what age you are. If you're listening, retired or not retired, this should be part of the ongoing discussions every year, because life happens. It happens quickly. And unfortunately, we're early into this year, and I've already unfortunately lost a couple clients this year, which just this past week, I had the discussion with their loved ones about inherited IRAs, what they need to take. You want to make sure you plan accordingly. And also, please make sure your beneficiaries are current. Please. You'd be surprised how many times they're outdated. They don't have any, or what have you. Make sure they're current. At Haven, we're looking at that. We're watching it. And if you don't have a partner, sometimes that can just go completely wrong.
Absolutely. Let me pose one last question about these inherited IRAs to you, Lance. Is it beneficial to get that money out of those IRAs if they belong to you before something happens to you? Can that be part of your estate plan? Or is it smart to just let them be and let your loved ones inherit them?
There's not a really great answer on that one, because again, it depends upon your situation. So if you're inheriting an IRA, you have your 10-year clock. We want to get that done. But if you want to leave it for all 10 years and then you die in year 7, well, then your beneficiaries are going to have to deal with the ramifications of that.
Yeah.
Do you have beneficiaries that could use it better than you? Do you have beneficiaries that know what they're doing, that they're not going to have to pay any penalties on that? So again, it goes back to your specific situation.
Sure.
I'm going to add to that, Kim, to the degree that from an estate planning background, if you can get that money out of the IRAs while you're still alive into some sort of other account, it might be very beneficial, maybe not for you, but for your beneficiaries. Because oftentimes when people inherit, say the kids, they're in their peak earnings years, they inherited an IRA from mom and dad, and they better say thank you. But they might be at the top of their tax brackets. Now they're going to get taxed heavily.
Sure.
It is where we want to get it out there if we can. Or if you have Roth IRAs, guess what? They go tax-free to the beneficiary. if that you're able to do that, that might be a good alternative.
Right. See, these are all those alternatives that most people may not know about, and they need to sit down with a partner as they're putting together their estate plan, because we all want our beneficiaries to benefit from that we leave behind, and not be burdened with taxes. So if you're someone who does not have a plan, or if you would like someone to review your plan, maybe things have changed over the years, give the folks there at Haven Financial Group a call. The number is 612-504-8400. Again, that's 612-504-8400. Everybody needs a partner when it comes to these kinds of issues, and the folks there at Haven Financial Group are ready to partner with you. When we come back, we want to talk about health, benefits, and planning beyond investments. This is the Haven Financial Group Radio Show.